During this process, you've gathered information about the client. You can have them complete the financial planning intake form, whatever it is. But I've gotten really good at sitting down with a client, knowing what their money is, knowing what their income needs are, just kind of knowing things about them. I've got a gift for it. I can kind of figure it out through the process. You may feel the need to say, okay, listen, to better further this appointment next week, I need to get some more information from you and stop and fill out the form. However you want to do it, it's fine, but there's ways to work it in throughout the process to kind of figure out most answers on the financial planning form. Would you guys and gals agree with that, by the way? Good, okay. You can do that, right? But if you want to make it kind of formal and fill out this form or sit down with them and fill it out, that's okay too, okay? Now, what's going to happen is you're going to submit your financial planning form. The first thing we're going to do is look at your current investments, all right? So I have people around me that are very, very good at analyzing accounts. We've got a team of CFPs that are at home office, and what they do is analyze client holdings for us and build financial plans. And this is what their analysis showed us about your portfolio. You're basically here in what we call a portfolio that looks to be a little bit balanced. See, right here you've got 44% stocks, cash and bonds here. So you're basically in a 60-40 portfolio, all right? The next thing you'll see is that right here, this right here is called a style box. And what this shows us is kind of how the equity exposure or stock exposure, which again makes up 60% of your portfolio, is allocated. And what I'm noticing here is ways to improve your portfolio, or I'm trying to find ways to help you and add value to improve your current situation. And I'm immediately seeing something that could help dramatically improve your situation. You see right there, it says the majority of your stock holdings are large cap companies. That's big companies. Formerly GE, Dow Chemical, you know, Dow Chemical, Apple Computer, Exxon, right? You used to say GE, but you can't do that anymore. They got kicked out of the Dow last week. So anyway, what we know is that smaller companies, international equities, and emerging markets, statistically over the long term, produce a higher return and a lower risk. So we could be getting more return and less risk in your portfolio by allocating some of your capital down here to these smaller cap stocks, emerging markets, international equities. All right? The next thing that we see is this style box, and this is based on your bond exposure, because you have 40% of your capital allocated to bonds. Okay? All right, so that 40% is allocated to bonds. Now, the reason why this bond allocation is here, Mr. and Mrs. Jones, is your advisor is trying to reduce the risk you're taking in your portfolio and trying to bring some safety in with bonds. All right? But here's what's really interesting about your portfolio. If you look right here, the majority of your bond portfolio are medium quality bonds, and they're really high terms or long-term bonds. Well, we have a situation right now where interest rates are going to go up. And as rates rise, bonds get hurt. The bonds that get hurt the worst are long-term bonds. So what this means is your portfolio is designed for you to get a return without a lot of risk, okay? And your advisor is using bonds to reduce your risk, but they're using long-term bonds that will get hurt the worst when rates rise. And we know rates are going to go up, right? So does it make sense to allocate your capital this way to help mitigate your downside risk in your portfolio? Back from 1980 to the year 2010, sure it did. Present day, not so much, all right? And you kind of get the client to make that decision for themselves. Keep going, and you'll see, okay, down here, we'll get into some more detail. Down here, I can kind of see what your equity exposure is, and you can go back to that same conversation about allocating more to international markets, emerging markets, and also small cap stocks, all right? And then we go over here and we look at your portfolio's 10-year average return. So your 10-year portfolio's average return is 7.02%. Not terrible, not great, all right? The next thing to me next thing we want to look at is this metric right here. And this is your maximum drawdown period is 31.53%. So what this means is from a peak to trough loss, your portfolio would lose 31%, potentially even more, if we had another 2008, 2009 financial crisis. If you, and I'm looking at your portfolio with $1 million value, right? If your portfolio went from $1 million down 30% to $700,000, would that cause you to consider a lifestyle change? It would, right? The flip side of that coin here is your portfolio in a good year could make as much as 48%. So if your portfolio went from $1 million to $1,480,000, is that going to cause you to change your lifestyle? Might make you feel better, right? You might travel a little bit more, but a lifestyle change, not likely, right? So what we're seeing here is that the return spectrum, the upside, downside, is probably not fitting your risk tolerance, all right? The next thing we'll go into is standard deviation. So we look at your portfolio standard deviation there, and we're seeing that it's 12. And, you know, standard deviation is one of those terms that you spit out there, Mr. and Mrs. Jones, and clients go, what the heck is that? All it is a measure of risk. The higher the standard deviation on the portfolio, the higher the risk. The lower the standard deviation on the portfolio, the lower the risk. What we want in a portfolio for retirement is a low standard deviation and a high return. Well, right now, we're seeing your standard deviation is 12, and your return on your portfolio is 7. You have a high standard deviation and a low return. A smart portfolio would actually flip-flop those numbers to a lower standard deviation and a higher return, all right? I know that Jeff Jr. has a conversation about beta. Beta can be a great conversation to have. I don't spend a lot of time on it, but basically I just say, look, if your portfolio has a beta of 1, it's going to move with the market. If it has a beta of 0.5, it's going to move half what the market does. And if the portfolio has a beta of 1.5, it's going to move it 1.5 times what the market does. I kind of take that same methodology there and focus it more on standard deviation than I do beta, because standard deviation to me is a better measure of risk, all right? Keep going through here. You could have a conversation about fees here, but obviously when you see fees this low, does it make sense to sit there and beat up fees? No, so don't do it, right? But have the common sense to go, well, wait a minute, I'm seeing these expense ratios are ridiculously high, right? That's the time to have a conversation about fees. But if they're like this guy's obviously using ETFs. What do we use in our portfolios? ETFs. So how the hell am I going to beat up fees with this guy's ETFs? I'm going to use ETFs in our portfolios. You with me? But if I see a lot of American funds with high expense ratios, I'll see that and go, hey, by the way, there's a good amount of fees here, all right? Just a little bit of common sense, okay? Keep going through here. And we get to this guy. And so basically what this is showing is risk return, right? Same conversation we had earlier with the client, okay? And we draw a line from the portfolio basically right through there. And what that is a risk return curve. Same thing where I drew out that out earlier, okay? What I'm showing the client here is everything above this line is actually adding value to the portfolio. That's good stuff. Everything below this line is where you've got weakness in the portfolio and is likely what is contributing to that large 31% drawdown, that high risk or high standard deviation, and that low average annual return. And you'd be very surprised at what a few small changes we can make to make this portfolio a lot better. What did I just do there? I didn't call their dog ugly, did I? Right? I said, hey, there's some changes that can be made to make this portfolio better. And I quantified how we're going to do, how we could do that. Here is another one. This is called a correlation report, all right? And basically what this shows is the top 20 holdings in the client account. And so, Mr. Jones, here's what's happening. When I see this, what I'm noticing is a very high amount of correlation between your assets. And what's happening here is a disservice to you, because you're going to get your statement in the mail and you're going to see that you've got 20 or more holdings. You're automatically going to think what? My portfolio is diversified. Well, if your portfolio is truly diversified, this matrix here would have a lot more orange, a lot more gray, and potentially even some dark orange in there, showing that it was truly diversified, all right? But at this moment, you're really not as diversified as you think you are. Now, I'm just curious, if the majority of these things up here that you're invested in are all doing the same thing, I wonder the last time your advisor went through all those investments and found the versions of those investments that had the best return, lowest drawdown, and lowest cost, and kind of consolidated them down and threw out the bad ones. When's the last time that happened? What has it? Well, you know, your current advisor could do you add some value to a relationship by changing some of these things out, because if you're working with us, we would absolutely do that with you and do that for you. Driving that wedge, right? All right, so that's your Morningstar report, okay? Now what we're gonna show you is how we took your current investments and we tested your current investments. So this is your basic information about who you are, your retirement expenses. These retirement expenses are grown for inflation. They are after tax, and based on today's dollars, to fund your retirement, your portfolio needs to generate a total of $5.1 million over the next 28 years. Next 28 years. If we say what that number is in inflated dollars in the future, your portfolio must generate $7.8 million for you to maintain the lifestyle you wish to live in retirement. So that's $182,000 a year in income after taxes, all right? Keep going through this, and this talks about the portfolio's annualized return and standard deviation. Does anybody know how to use annualized return and standard deviation, by the way? A lot of people don't know this, okay? It's actually really simple. I'm gonna make these numbers round, and let's say the average return is 7. So what you got here is a curve, okay? If the standard deviation is 12, that means the portfolio, if it goes out one standard deviation, can make 19%. Or if it goes minus 12, that means the portfolio could lose minus 5%. The S&P 500 has gone 3 standard deviations outside of its norm many times. If your portfolio goes 3 standard deviations outside of its norm, we're at minus 17%, minus 29%. Portfolios moved to the downside, standard deviation wise, 90% more times than they move to the upside. So basically what this is saying is that you have the potential to make 19%, or turn your $1 million portfolio into $1.2 million, or turn your portfolio from $1 million down to $700,000, right? So what we want to do is kind of bring in that range of returns, all right? Here's your accounts. This is as they are currently laid out. Again, we need all these listed and that sort of thing to run this report for you. We'd obviously have those from running the Morningstar report, okay? Here's just kind of gross cost basis if we've got it and all that kind of stuff. Here's Social Security, having a conversation about Social Security based on the way we've formatted to take your Social Security, growing for 1% inflation. The total amount of money you receive in today's dollars Social Security is $1.5 million, or $1.757 million inflation adjusted. All right? Keep going. And this is where the rubber hits the road. Based on your current relationship and what your current advisor is doing with your money and what you need your portfolio to generate for you in retirement, you have a 51% chance of success. What this means is we ran this through 1,000 simulations. Yes, this is a Monte Carlo simulation, okay? We ran this through 1,000 iterations of your risk numbers, your average annual return and your risk. And this portfolio was able to achieve your goals 510 times, or 51% of the time. Which also means your portfolio has a 49% chance of failure. All right? Mr. Jones, I'm just curious, what do you think about that? And shut up and listen. All right? Now, we can keep going here. And your worst case scenario is, at the ripe old age of 90, you start running into a shortfall of $800,000. Your best case is, your worst case scenario is you're at 1.228 million. Your best case is 3.47 million. So, Ms. Jones, I'm just curious. If your portfolio had a 51% chance of providing you $182,000 a year in after-tax income, and had a worst case scenario of you being short $1.2 million in retirement, or being positive $3.417 million in retirement, would that be okay with you? And they're going to go, no. See, Ms. Jones, what I really strive to do is this number right here, I don't really care about. If it happens, great. The number I'm most concerned about is this one. I want this number to be positive no matter what. I don't want my clients running out of capital if I can prevent it, all right? So we keep going through this, and what this does here is it's basically is an income report, and it ties in all of their accounts. We can tie in annuities to this. We can tie in annuities for accumulation, annuities with income riders, pensions, anything we want to, Social Security, all this stuff. And what it does is takes the client's assets, the beginning portfolio value here, the income amounts they're taking out here, their effective tax rates here. Anybody do Roth conversions, by the way, with their clients? Well, if my tax rate here is only 8.39, 10.58, 10.2, 10.58, 11.78, 14, couldn't I be doing some Roth conversions to take advantage of those low tax rates? Pretty cool stuff, huh? Okay. And then here's the residual value left over time. So at age 90 years old, based on this one, there's $1 million left in this plan. So the bottom line is you now have the ability to show the clients an aggregate investment amount, the income they're taking after tax, and the residual amount of money left over after they take those withdrawals. Pretty cool, huh? And that's for annuities and managed money, guys and gals, in one program. Yes, ma'am.
Before you got to the income plan,
okay,
and you're going through all that, you know, do you have people that say, this is just over my head, it's too much for me to...
This part, no. This is really simple. Here's what your Morningstar report shows. And you have to sense that. And that goes back to the whole client builder thing, okay? Who am I talking to? Am I talking to a guy like Brian? I'm gonna say, Brian, you can lose 30%. Do you wanna do that? Well, no, I don't lose 30%. What can I do to make it better? Well, put it in this portfolio that only lost 10%, the same time your portfolio lost 30, and that portfolio only made 7, the same time as this portfolio I wanna put you in made 21. You got to be basic, right? If you got an engineer, yeah, you got to go through this. That's why that client builder thing we're talking about is so important to kind of identify where you are in the process, okay? And you don't have to go through all this stuff. I have plenty of advisors out there that just do this portion right here only. They don't get into any of the module 1, 2, 3, and 4 stuff. And it's what you're comfortable doing. Like Kevin in the back, Kevin's soaking up stuff in it like a sponge back there, but I do not want him to go change his sales process. Why? Because the guy's probably the top guy in the room. He's killing it, okay? Is he going to take tidbits of what I'm showing up here and take it back? Sure. The one area that I will tell you that you will benefit from the most is this section right here, which I'm sharing with you now, is it. Because how many clients, how many advisors have told clients, let me just test what you're currently doing. You know, you go see the advisor, they want you to do business with them, they want you to change everything, right? Well, what's their basis for making that assessment? That they test what you're currently doing to validate their assumptions. If we test what you're doing a great job, and your probability of success is higher than 85%, there's really not much we can do, or that we should do, unless there's a big dispersion between these best and worst case scenarios. We might try to tighten that up a little bit, right? That we can help you do. If your probability of success is low, then you probably need to make some changes. Okay, but we're going to test that and validate that before we go tearing your portfolio apart and putting it back together. You see, I'm on your side, okay? All right, so we'll pull a Vanguard, all right? And just quickly, what I'll show you is this. What was the average annual return of your portfolio? 7%. What are you paying your advisor, by the way? You said 1% a year, right? Okay, 1%, right? Interesting. Very interesting to me that you're paying your advisor 1% a year to achieve a 7% return. Wouldn't you go out and not pay any advisor at all 1% a year to go out and achieve a 7% return? You find that interesting? Yeah, I sure do. And what else is interesting to me is that the drawdown, peak to trough drawdown, the loss potential of this portfolio is 18%. What was the loss potential of your current portfolio? 31%. Does that make sense to pay an advisor fees to put you in a portfolio that has the same average annual return but a higher drawdown? Does that make sense to you? Interestingly enough, this portfolio's got a lower standard deviation. So I'm getting the same return, lower risk, and lower drawdown. And you can go do this on your own right now without working or paying a financial advisor at all. What do you think just happened in the client's mind to their current financial advisor?
He got fired.
They just got fired. They just got fired. Did I fire the advisor? No. I helped the client have the information they needed to fire the advisor, right? That's why you show this step. I have advisors call me up, why would you ever point a client to Vanguard? Well, look, dumbass, if they're going to go to Vanguard, they're going to Vanguard with or without you anyway. So get that stuff out in the first part of the meeting and don't waste your time. But the client you're going to do business with, they're going to see this and go, A, I appreciate this. B, I didn't know this. C, thank you for sharing this with me. And yeah, whether it's with you or somebody else, I definitely need to make some changes. Well, thank you so much, Ms. Jones. Just don't forget who shared this information with you. Right? All right. Now, Ms. Jones, I've taken you through this process. And we've had 3 meetings together now. Okay? We've learned a lot about each other. All right? Now, would you like me to share with you now how taking a balanced approach, utilizing the out-of-the-market investments and the in-the-market tactical investments that you told me that you like, how taking a balanced approach between those investments could really help your situation? Sure. No, Ryan, I don't think so. Okay, well, have a nice day. I appreciate you coming in, you know. Or I'd say, hey, you know, we had an advanced agreement. This was the way it would go down or whatever it is. They're usually not going to say no, okay? Well, here's what you say. Ms. Jones, listen, if what I'm about to show you puts you in a better situation, provides you peace of mind, comfort, has a high probability of success, lower risk, lower cost, all those good things, do you feel like you and I can move forward today? Depending on what it is, Ryan, I think we can. Or I don't know. Okay, that's fair. When I go through this, again, if I don't think this is for you by just kind of the way your feedback, I'm going to tell you this is not for you. And I'm going to ask you the same question or to pay me the same respect in the instance that if you don't feel like it's for you during this process, you're going to tell me. Or if you don't understand something, you're going to tell me. Is that fair? Okay, let's get started. So, what I had my financial planning team do is put together a plan utilizing a balanced approach. So, when we take a balanced approach, here's what happens. Remember I talked about how reducing your risk and increasing your return will be a very smart thing to do? That is exactly what we did. Your question is, how do we do that? Well, we took your portfolio and we rebuilt it from the ground up utilizing some of our money managers. There's our money managers there. We put some of your money in the Trailblazer program that we talked about. Put some more over here with our money managers. Your wife said that she loves her United Airlines stock. We kept that the way it is. We're not going to change that. By the way, if you guys and gals don't know this, we don't offer advisor managed accounts on our platform. You can't manage money on our platform, okay? But if you have a client who has holdover stock that has like Exxon stock they inherited from grandma they don't want to sell, you can put that on our platform. Do you hear me? Okay? Yes, if you have a client that has Exxon stock and their account at Schwab and they want to move everything to TD Ameritrade, we will let you put that stock into an account at TD Ameritrade so the client can have all their accounts in one place. So anyway, keep going through here. Here's your Social Security. We already talked about that. We've got this Allianz 222 annuity with income to kind of replace things or combat inflation on down the road. Show an income rider. And I'm just showing you guys and gals that to show you F&G for accumulation purposes using the Trailblazer Index and using the Allianz 222 for an income rider. We have the ability to model both these things in here and actually did show this to the client, by the way. So this case closed, okay? It was a nice little payday. And guess what? I didn't close it, my advisors did. Pretty cool, all right? So based on making a few small changes to your portfolio, reducing your risk, increasing your return, taking a balanced approach between risk investments and safe investments, we're able to achieve a 96% probability of success on your portfolio. Now, Mr. and Mrs. Jones, I'm just curious. If you got to the airport and there were 2 planes you could get on, and the first plane had a 51% chance of success of making it to its destination. right? And the captain came over the radio and said, hey folks, everything's good, but there's only a 51% chance we're going to make it to where we're going today. For those of you who want to get off the plane now, you can. Okay? And by the way, there's a plane right next door to us going to the same place that has a 96% chance of success. Okay? Would you stay on the plane with a 51% chance of success and make it to its destination, or would you get up and get off the plane and go get on the plane with a 96% chance of making it to its destination? And that's what I'm offering you today, Ms. Jones. All right? So what I'd like to know right now is kind of what your thoughts and input are on this plan and what you feel like the next steps are. And there you go. Or you can do what? What else can you do? To get this process started, all you need to do is make a photocopy of your driver's license, and you have that with you today. Boom.
And then you would move some money to your TD or wherever, and then deal with the employee application.
Yeah, guys and gals, do not ever again, if you have a Series 65 license, move money directly from an insurance, from a brokerage account to an index annuity. Do not ever do it again, okay? Move the money to TD Ameritrade first, then move it out. But do not sit there and call yourself a fiduciary and lie on a suitability form. In addition to that, if I find out any of you are surrendering annuities and moving that annuity into my platform and then lying on the suitability form about source of funds, moving it back out, we're going to have a chat. Don't do that. Don't do that. Okay? Ask me how I know it happens. I caught some people doing that got in some serious trouble at my previous company. And not with me, by the way, with the regulator. So don't do that kind of stuff. All right? Your license is your most valuable commodity. Protect it. All right? Okay, so that's planning. This is the new report that you will get from Murray when you submit a financial plan. Now, if you don't want to use this, don't have Murray do it. On our planning submission form, it'll say Morningstar report, in-stream report. If you want both, check them. If you just want to use the Morningstar report, that's fine. All right? But this is a very simple plan. It's not 100 pages long. All right? Very easy to use, very to the point, and it works really, really well.
I have some situations where I have folks where one member of the couple is below the magic 59.5 or can't get in-service distributions from their 401ks and are still working. Is there a way to design this so that the money that has to stay in those accounts can stay there?
Yeah, all day long. We can show contributions to the account, and what we would do is we would probably look at it from a 60-40 balanced portfolio. So we would make that up in in-stream, basically, and we could also show contributions going into our account as well. Yeah, this is a very robust system. It's very robust on the things you can do with it. That's what I really like about it. But the reports it spits out are not 800 pages long. Clients can actually understand this and take it home and feel it and touch it and get a handle on it.
Is this the same report that before, if we wanted to have a financial plan, the client had to pay $1,500 or $2,000 together?
No.
This isn't the same thing that...
The client is not paying for this. This is a value-added service. Now, here's a question. Can you charge for this? And the answer is yes, you can. You can charge for this, and we have a document that you can give a client and charge for it, okay? You have to disclose you're going to charge for it, all right? In that scenario, why would you charge for it? Very simple. If you charge the client for it and you deliver the value and the client wants to go somewhere else, they can. Because they feel like they gave you something for the value you receive. And what that ultimately does is it kind of gets rid of that stigma between you and the client. Because they're thinking that you're going to do all this work and expect to move the money, right? And if you don't move the money, they know that you put work in. They're not stupid, and you're not getting paid for what you did. And that kind of creates a little bit of an error between you and the client, doesn't it, right? The way you can break that barrier down is charge for the plan. I charge $5.95 for a plan, Ms. Jones. And so what that does is I get compensated for the time that I put into this, and I will give you a money-back guarantee. If you don't think it's worth it, then I don't even do a money-back guarantee. So listen, you don't pay me until after I present the plan. If you don't think what I showed you is worth what I showed you, you don't have to pay me. Pretty simple. Or you can do it the other way and say, if you pay me, I'll give you money back guarantee. No questions asked, you know. I have done a lot of planning. I've charged for a lot of plans. You know how many clients have actually paid me for plans? 0. Because most of them at some form implement the plan, right? Yeah, and so there's a lot we went through here today, okay? We got to do compliance now, which is going to be fun, but there's a lot we went through here today, all right? The thing I want you guys and gals to realize is that we now have the stuff on video. It's going to be out there on video. You can use it, that sort of thing. A lot of you in this room are experiencing success. Don't change what you are doing, okay? Take some of this stuff and implement it into what you are doing and make yourself better, all right? But don't come up here and try to be Ryan Wheless. You're not going to be, and I'm never going to be able to be 𝗶𝗵𝘃𝗀𝗃𝗁 because I'm Ryan Wheless, okay? And that's not good or bad. It is what it is, all right? But I've just shown you a methodology from start to finish that I use to build an $80 million book of business, $200 million in annuities, and over $1 million in target premium life. This is exactly how I did that. All right? So if you have questions on this, you need help on this, I'm here for you anytime. You can get a hold of me through Lori. Say, Ryan, I need to talk to Ryan. I'm having some issues on this. I need some help. And the calls that I enjoy the most are, I need some help. I love getting, whoa, somebody said, who, get them on the phone right now. What do they got, right? Now, don't call me up and say, you know, I got Miss Jones and I can't sell this $10,000 annuity, right? Call me up and say, Ryan, I'm having an issue implementing this in-stream report and this planning stuff, or module 1, I need some help on that and that sort of thing, right? And just be mindful of that because I am only one person, okay? We'll be training out a business development team underneath me and that sort of thing over time. It will take time, but just know that I'm here to serve you, I'm here to support you, and I'm here to coach you, and here to help your business to grow.